Want to get a real handle on how a major company's doing, but without drowning in numbers. Let's unpack this. Today we're taking a deep dive into the Hayleys FY 2024-24-25 interim report. We've got their official financial snapshot right here for the year ending March 31st, 2025. And we're going to, cut through the noise and figure out what these numbers really tell us compared to last year. Our mission, simple: extract the key insights, find the real story of their performance.
Exactly. And what's particularly useful about an interim report like this one is you get to see the company's trajectory, right? By comparing this year to last year, we can see not just where they stand now, but, well, the direction they're moving in, the momentum.
Precisely. Okay, so let's jump right in. The big picture. Overall financial performance. Let's start with revenue, the total money coming in. It saw a pretty significant climb. For the year ending March 31st, 2025, it hit Rs, 492,201 million. That's a healthy 13% increase from the previous year's Rs, 436,732 million.
To 13% is solid growth year over year.
Yeah, and it wasn't just the whole year either. The last 3 months, Q4, that showed a strong 15% jump compared to the same quarter last year. So Rs 128,661 million
Yeah.
versus Rs 112,236 million.
Yeah.
Seems like they finished strong, right?
The consistent growth and even accelerating a bit in Q4, yeah, that usually points to strong underlying demand. And when you think about Haley's, they're quite diverse, aren't they? Eco solutions, hand protection, lots of areas. So this broad increase could mean strength across several of their sectors.
Okay, makes sense. Moving on to gross profit. That's revenue minus the direct costs of making their stuff. We also see an increase for the full year, up 8% to Rs 118,312 million. But interestingly, the growth in that final quarter, Q4, was much smaller, just 1%. Rs 31,898 million versus Rs 31,726 million. So why might that gross profit flatten out in Q4 even with revenue surging?
That's a good question. It suggests that while they sold more, the cost of actually producing those goods in that final quarter must have risen almost in lockstep with the revenue, squeezing that margin just a little bit.
Okay.
And if we look ahead slightly in the report, we see the cost of sales figure did increase by 15% for the whole year, but by 20% in Q4. So yeah, in that last stretch, it cost them proportionally more to deliver.
Got it. So selling more, but each sale was, let's say, slightly less profitable right at the end of the year. Now, here's a really eye-catching figure. Profit for the entire period. That jumped by a huge 52% year over year. To Rs, 22,513 million from Rs, 14,847 million.
Wow, 52%.
And even just for Q4, it was up a solid 12%, reaching Rs, 8,630 million. That's a massive leap in overall profitability, isn't it?
Oh, definitely. A 52% increase for the year is, well, that's a headline number right there. It suggests that even with that higher cost of sales we just talked about, other things must be really boosting their bottom line significantly, which is why, we need to dig into those specific income and expense lines.
Right. When we look specifically at the profit that belongs to the owners, the shareholders,
Yeah.
that increase is even more dramatic. A massive 95% jump for the year. Rs 13,449 million versus Rs 6,889 million.
95%.
And Q4 saw a healthy 25% rise too. Rs 5,876 million versus Rs 4,708 million. And as you expect, that flows right down to earnings per share, the EPS. They nearly doubled for the year, went from Rs 9.19 to Rs 17.93. I imagine investors will be pretty pleased with that.
Oh, absolutely. EPS is such a key metric investors watch. A jump like that usually makes the stock look much more attractive. Better profitability per share.
Okay, so a huge surge in profit. Now let's figure out why. Let's delve into those key expense and income movements. We mentioned cost of sales already. What else jumps out at you from the income statement?
Well, one thing is other income. It shows a very substantial increase, 45% for the year. Now, this isn't income from their main day-to-day business, right? It could be things like, say, profit from selling off some assets or maybe returns on investments. A 45% rise there would definitely have helped boost that overall profit number.
That makes sense, like an extra income stream kicking in. What about the expenses side? Distribution costs, getting products to customers, they rose 15% for the year. That seems sort of in line with the sales increase, doesn't it?
Yes, that feels about right. Higher sales usually mean higher distribution costs.
But interestingly, administrative expenses, the sort of day-to-day running costs,
Yeah.
only saw a small 4% increase for the year
Yeah.
and actually decreased by 4% in Q4. That looks like some pretty effective cost control, maybe.
It does suggest that, yeah. Keeping admin costs relatively flat, especially with that decrease in Q4, it points towards a focus on efficiency. On overheads, however, The big one here is other expenses.
Hmm.
This category saw a truly enormous increase, over 1,000% for the year.
Wow, 1,000%.
Yes, and even in Q4 alone, it was up 72%. That's a huge swing. We'd really need more detail to know exactly what's in other expenses.
Hmm.
Could be one-off things, maybe write-downs, perhaps costs linked to those acquisitions we'll get to later. But that's definitely something to keep an eye on, a major flag.
Absolutely, 1,000% definitely makes you pause. Now, another really interesting movement, net finance cost. It dropped significantly down 30% for the year, and even more, 41% in Q4.
Mhm.
You mentioned earlier this was driven by finance costs falling more than finance income fell. Why is that so important for their profit?
Well, a drop in net finance costs basically means they're spending less on things like interest on their loans, their borrowings. Maybe they paid down some debt or refinanced loans at better rates or just borrowed less overall, though we'll see about that later. When these costs go down more than any drop in income they get from, say, their own investments, the net effect is a significant boost to profit before tax. Less money going out as interest just flows straight to the bottom line.
Right, less debt servicing equals more profit. Simple as that. Okay, let's pivot slightly. Look at other comprehensive income, or OCI. This stuff doesn't hit the main profit calculation immediately, but it affects the company's overall value. A couple of big items here. First, a huge gain R6, 6,524 million from revaluing their land. That's a big jump in the value of their property.
Yes, a revaluation gain that size significantly bumps up the company's net asset value, their equity. It's not cash profit right now, but it shows an increase in the underlying worth of assets they own.
Okay? And we also see a swing from a loss to a gain on employee benefits, probably related to pension cost estimates.
Likely, yes. Changes in actuarial assumptions can cause those swings.
And also a big positive change in net exchange differences from translating their foreign operations. Put it all together, and it's a pretty chunky positive number for total OCI this period.
Yeah, these OCI items show changes in their financial position not directly tied to this period's core operations. Those positive exchange differences suggest currency moves have worked in their favor regarding overseas assets or deals, and the actuarial gain suggests a positive tweak in their long-term employee liabilities.
All right, let's shift gears again. The statement of financial position, the balance sheet, snapshot of what they own and owe. Total assets have grown quite a bit. From about R's 442 billion to R 511 billion roughly. Where are the big increases in what they actually possess?
Okay, looking at non-current assets, the long-term stuff,
Hmm.
we see growth in property, plant, and equipment. Suggests they're investing in physical assets, maybe building things, buying machinery. Also, non-current trade and other receivables are up, could be longer payment terms for some customers.
And current assets, short-term things.
Significant increases there, too. Inventories are up, which kind of makes sense if sales are higher. They need more stock. And trade and other receivables, short-term ones, are also up. Means more customers owe them money in the near term.
Okay, now the other side of the balance sheet. What they owe and the owner's stake. Total equity, the owner's bit, has grown. That's good.
Mhm.
But we also see increases in liabilities, both non-current, long-term debt, and current, short-term debt. And specifically, interest-bearing borrowings are up in both categories, long-term and short-term loans.
Yes.
Which brings us to the debt-to-equity ratio. That climbed from 2.57 to 3.17. So basically, they're using more debt relative to equity than before. Now, profits are strong, but should that rising debt level be a concern?
Well, it's something to watch, definitely. A rising debt-to-equity ratio means the company is relying more on borrowed money. Leverage. Debt can fuel growth, sure, but more debt means more risk, higher interest payments down the road. And, less wiggle room if things get tough economically. So, yes, it warrants attention. Needs to be manageable.
Right. More debt could bite into those profits later.
Hmm.
Okay, now, the cash flow statement. Actual cash moving in and out. And here's something interesting. Net cash inflow from their core operations actually decreased quite significantly, down from about R's 30 billion to just under R's 12 billion. So higher reported profits, but less actual cash generated from the day-to-day business. How does that work?
That's a really crucial point. Profit isn't always the same as cash in the bank. A difference like this often points to working capital changes. Remember those increases in inventory and receivables we saw on the balance sheet?
Yeah.
That means more cash is tied up, sitting in warehouses as stock or waiting for customers to pay their bills. So less cash actually flowed in from operations, even though the accounting profit looks good.
Ah, okay. So the cash is sort of stuck in the system temporarily. Meanwhile, cash used for investing activities increased. They spent more on property, plant, equipment, other long-term assets, so investing back into the business.
Yes, that lines up with the balance sheet changes. They're putting capital into expanding or upgrading. Could be positive for future growth.
And finally, cash outflow from financing activities, things like debt and dividends that decrease significantly. Looks like a mix of taking on new borrowings, repaying some old debt, and also paying dividends to shareholders. It seems like they've been actively juggling their finances.
That decrease in the net financing outflow, even with debt repayments and dividends, it suggests they probably took on quite a bit of new debt during the year overall, which connects back to that higher debt-to-equity ratio we saw. But paying dividends shows some confidence, doesn't it? Even with the borrowing changes.
True. Let's briefly touch on their different business segments. Haley's is diverse eco-solutions, hand protection, agriculture, consumer and retail, and more. Did any areas really stand out in performance?
Well, the report emphasizes that diversity, but it does note that the consumer and retail sector saw substantial increases in both revenue and its segment results, its profit contribution. So, strong performance in their consumer-focused businesses. Figuring out why new products market share gains would be interesting.
And they've been growing through acquisitions too, it seems. Bought a controlling stake in Advantis Leo in Thailand and all of High Care Thai gloves. Strategic moves, expanding their footprint.
Definitely signals an expansion strategy geographically into Thailand and boosting their glove manufacturing. Integrating these successfully will be key, obviously. The report gives a little hint about the value of assets they got and if they paid a premium goodwill or got a bargain.
Okay, nearly there. Let's glance at investor information.
Yeah.
Share price saw a big jump, Rs 82 up to Rs 137. Market cap total company value also up substantially, likely reflects that strong profit growth we discussed.
Makes sense. Market usually reacts positively to that kind of profit news.
But the price to earnings ratio, the PE, actually decreased from 8.94 down to 7.64. How do we read that? Price is up, but PE is down.
Yeah, it means earnings grew even faster than the share price did. So investors are essentially paying a bit less for each rupee of earnings compared to last year. You could argue it suggests the stock might be, relatively speaking, more attractively valued now compared to its earnings power.
Interesting. We also see net assets per share went up. That debt-to-equity ratio we already talked about. Public holds about 37% of the shares, and Mr. KDD Pereira is noted as a top shareholder with a big stake.
Yeah, that investor snapshot gives context. Market view, ownership structure. A large individual holding can sometimes influence strategy, as you know.
And just a couple of final quick points from the report. They successfully issued a lot of debentures like corporate bonds. Shows they can raise debt capital. Contingent liabilities, potential future costs haven't changed much. That's good. And it all follows Sri Lankan accounting standards, LKS 34 for interim reporting.
Right. The debenture issue gives them more funding options. Stable contingent liabilities means no major new off-balance sheet risks popped up. And following the standards ensures, reliability and comparability. Foundational stuff.
Okay, so let's try and wrap this all up. This deep dive into Haley's interim report, it shows a company with, well, really strong growth in revenue and particularly profit. We flagged some big movements in expenses, especially that huge jump in other expenses and shifts in assets and liabilities, including more debt. They've been active 2 acquisitions, raising money via debentures, and the market seems to have liked it, pushing up the share price and market value significantly.
Exactly. The headline is that impressive profit growth. But the nuances we found that surge in other expenses, the higher financial leverage, the lower operating cash flow despite higher profit, those are really crucial for let's say, a more complete picture.
So here's the final thought to leave you with. What's really driving this big financial performance? And crucially, how sustainable is this growth path? Especially when you factor in those rising other expenses and that disconnect between profit and operating cash flow. It really makes you wonder about the bigger economic picture Haley's is operating in and what their strategy might be going forward. Definitely something to think about. Thanks for joining us for this deep dive.